Welcome to Alpha Bytes, where each week you get a behind-the-scenes peek into crypto researchers doing the dirty work to find tomorrow's alpha. I'm your host, Marconi White, and today's show is so hot, Ray had to skip it just to cool down. I'm going to ask the guys where they're investing outside of crypto for the next 10 years. But first, JJ explains whether the echo bubble has finally popped. We ask and answer whether Avalanche is a beta play to Ethereum. King Kodi likes or spikes 3 projects, including Maker ETH hitting a 1-year high, a layer 2 for Bitcoin that runs an EVM, that sounds crazy, and an L2 rollup that involves Solana, Ethereum, and Celestia. That sounds complicated. And I asked the guys what data caught their attention this week. There's going to be a lot here. You're not going to want to miss it. I've got Ben Lilly, JJ, and Kodi in the studio. Gentlemen, welcome. It's another hot week in crypto, so let's dive directly into the market update. JJ, I want to ask you were here last week and you were talking about placing bets on the FOMC and on the quarter close. Tell me, how are your bets working out?
Barring a technical miracle, I believe the 2023 echo bubble is over.
Oh.
So FOMC last week.
Okay.
As we discussed, there was like a window of opportunity there where it looked like Bitcoin could reconquer its trend, get back above the 200-day moving average. Instead, we saw it pretty firmly fail there at the 27K resistance. 50 RSI and the daily and weekly charts failed. Just pretty textbook technical resistance there that pushed Bitcoin back down to the low 26s. Obviously, DXY, a lot of the hawkishness we heard during Powell's speech, that rhetoric wasn't priced into markets, right? So we saw the terminal rate move higher, which ultimately sent DXY higher. So now we have that technical pattern of the death cross on the Bitcoin chart and the DXY golden cross, and those patterns seem like they're confirming into the monthly close. These are historically potent technical signals. Not coincidentally, they're happening at the same time. Bitcoin, as we know, that obeys technical signals like that pretty frequently. High hit rate on those. Legacy markets can be a bit more prone to shakeouts and misdirection, so given that Bitcoin is being institutionalized right now, given BlackRock interest and what have you, we can't rule out completely that this is just some kind of a complex shakeout. For me, the line in the sand that would basically signal that this has just been a prolonged shakeout period and it's wiping out the leverage would be a reconquering of 27,500 prior to the first week of October, but it really doesn't seem likely. Everything technical-wise, it's just finding it very hard to find any kind of bullish narrative to cling onto here. We do have the ETF decisions coming up in October. Most likely those will be delayed again. I do think that we would see Bitcoin getting bid up pretty steeply there if there was to be a bullish announcement. I think insiders would front run that information so you'd have time to react. We don't see that now currently, obviously. Bitcoin's kind of been sliding. I think it's setting up that we are almost certainly going to retest the range lows and get a wick below 24,000 into the end of the year. Possibly fall below 20,000 and get a retest of March support. So yeah, it's not looking good.
So
and if you consider, like, one thing I wrote as I was making my notes for this morning's show is that Bitcoin opened the year around 16,500, right? And we forget because of how quickly Bitcoin went up during quarter one that it's still up a massive amount throughout this year. So don't be surprised if it just closes the year. It's still a bear market, only up a modest amount. Like, granted, 19,000 would be it's almost a 25% increase or so year over year. So things will even themselves out to the end of the year, I believe, barring some kind of really bullish miracle here.
So we've really now had more of a bearish outlook as we move forward, as Bitcoin just really hasn't been able to regain those technicals. And it doesn't sound like you're very confident that they will as we head into the quarter close.
Yeah, there's no reason to. Like, I really saw this past 3 weeks as a window of opportunity there where it would catch a lot of people off sides and accelerate. I think if we were going to get a bullish ETF announcement, it would have been started to get priced in already, right? There's always somebody who knows the markets. People with inside information obviously take advantage of that. Bitcoin isn't as regulated as other stocks and what have you. So I do think we would see it priced in. There's still a chance that we could see it get priced in over the next couple of weeks, but with every day that passes that Bitcoin isn't back above 27.5 or so, the likelihood of any kind of bullish announcement coming in the near future just keeps going down.
Keeps going down. Let me back up. I want to go a little bit more to the macro because you started off talking a little bit about the FOMC, the hawkish language that came out. They kept rates, but I think they opened the door for more rate hikes in the future. And the Dixie is continue to look pretty strong. Are you seeing any signs at all that there's a structural change to how the Dixie is going to respond to these rate changes? Anything that's caught your eye from a change now that I think the market appears to be settling into higher for longer?
Dixie's overbought now, and I think it's just going to continue to get overbought. It keeps having these brief drawdowns and then right back up, brief drawdowns, right back up. So it's forming a healthy pattern to keep chugging higher, similar to the way it did in 2022, where everybody was waiting for it to fall, and then it just went from 97 range to 114 with just very minimal drawdowns in between. It seems pretty similar to that, and I think my opinion as of right now is it's just going to keep going higher into the end of the year until we finally see markets break, and then we'll obviously see it devalued when it has to be devalued. But I think we're a ways away from that as of now. The difference between prices, what they look like now, and what they look like when markets finally break it's quite a wide gap there. So you're looking at Bitcoin certainly sub 20,000 at the point when that comes. So probably not a good idea to step in front of a moving train here and try to call a top on Dixie when it's moving like this.
Okay. Ben, I want to ask you, we've talked a couple of times about the end of the quarter, and we're hitting on the end of quarter close now. It looks like max pain is around 26.5. What's your perspective on what JJ just shared in terms of where the market's going? And do you have anything that would counter the technical review that he just gave?
As much as I would want to try to counter anything, I got nothing. I agree with everything JJ's been saying. I think one of the more important topics he hit on was regarding the ETF, that this is not as compliant of a market as other markets exist. And so you would likely see some front-running activity taking place prior to, I believe it's October 17th, I think is the date that the SEC needs to respond to the NASDAQ's listing request of the BlackRock iShares ETF. And if that was a very favorable outcome, especially as we get closer to that date, you can really try to keep an eye on it. But because we don't see it, then we probably shouldn't be expecting anything anytime soon.
Okay. I do think when it was first announced that BlackRock was coming out, I think we even talked about on this show, there's only one ETF that they have tried to put into the market that didn't actually make it to market for all their submissions. This would be the second one if it doesn't actually go through. JJ, I want to bring it back to you. Do you think that, what's your perspective on them actually getting this done? I feel like...
I think it will.
You think they will?
Think you're
okay.
Right. But it's not till March, right? By March, Bitcoin could be trading at capo range 12,000. So and I think they would almost prefer it if you were somebody, if you had a lot of money sitting on the sidelines, institutional type size, you would rather wait for kind of everybody who can be purged out of this market to get purged out of the market, and then you can buy as much as you want, ride it up to new highs. And so I think it's setting up for that. And yeah.
The coincidence there, if it were to be in Q1, that decision lining up with the halving, and in a post-halving Bitcoin market, we just tend to go north above that 200-day moving average and never look back. I don't think there's been a cycle to date in a post-halving market where the price has dipped below that 200-day moving average before we top out, which just shows you the speed at which the market tends to move post-halving. And if you have that type of big event that coincides with the timing, this could be a very fun market.
Yep. Fun market.
I think that's the move, is you just wait till January, February, see how the charts are looking then, and then just try to front run the ETF announcement. Hopefully Bitcoin's at some sort of substantial lows at that point. But I think the party's over for now, unfortunately.
Party's over. So I think frequent listeners would probably point out that we've talked about patience on the show. We've talked about being prudent. I'm hearing that again today. So something to be considering when you're looking at your portfolio and allocation. JJ, as he just said, party's over for now. Be patient. Wait for those opportunities to come back. As Ben just pointed out, the halving, not the happening, as one of our frequent listeners pointed out that I pronounce it incorrectly all the time. But that's going to come up, and that could be a big catalyst for the market. Kodi, I want to bring you up. It sounds like you have something you want to share with the team.
Yeah, I keep listening to various takes, and I just want to say, on Twitter and on the spot, of course. And I don't know, I look at the chart, and there was an attempt to drive the price below 25K, and that was about up immediately. And now, last week, we had the Fed, getting really hawkish, moving the dot plot, yields are exploding higher, the S&P, NASDAQ following suit down, but Bitcoin is just chilling. And yes, we can see, we can see it might be one of those things that it just waits a bit and then it dies. But I think unless we lose 25K, I think it's a bit premature to just call it dead, because I don't know, markets don't, markets go up, down, they oscillate, right? They don't just follow one path, unless you're the Dixie, of course. But yeah, if come October, the S&P traditional markets can they take a breather, they might find some support at 42,000 for the S&P. Maybe Dixie takes a breather, and then it wouldn't surprise me if Bitcoin is above 25K for it to at least challenge 30K again. Now that might be it could paint a head and shoulders. It could be just resistance again. I just wouldn't discount something like that, and it could perfectly do that, and then die again in January and February and find that eventual bottom in March. But I think you should be aware that, if the opportunity is there in the following weeks and months, I think you should take it if you think that the bearish path that it should have taken hasn't been taken, and then it presents an opportunity to go long. That's all.
I agree with that. That's one thing that I've been saying too, and we've been discussing together, Kodi, is that how confusing this market is and how like resilient Bitcoin has been despite DXY at 106.17 right now, and Bitcoin's still at 26. That's why I put that 27.5 range in my mind as like the line in the sand. If it gets over that, then it's probably all that bullish catalyst and stuff it'll make sense why Bitcoin didn't break down. But I think this is a no man's land range, it seems to me, where it's so much more risk than reward from the 26 range, given everything that we've been discussing. But if you start to see a strong bid, then I think, you just flow with it.
I mean, who's selling right now? You've been in this drawdown market since the Fed started raising rates or signaling that they're going to be raising rates, and we had all the turmoil unfold last year. And now we're sitting here, we had a little bit of positivity. We have what we think, I would say, is consensus is that the ETF is coming here shortly, and then we're moving into a positive cycle. It's like the only entity or individual that would go ahead and sell is going to be a news event, and it's not going to be essentially I'm exiting the market. It's going to be just a very short-term speculative move, and then volatility being as low as it is, you need to have the jolt by getting that kind of liquidity sweep to the downside, which to me would point to, I hate to say it, I don't really want to bring it up, but just to create this news headline event that could create something like that is that Binance event. And then that would be almost a spark where all this dry powder would come in on the market. It would feel less frightened to get involved and feel less sensitive in terms of a time component, because a lot of what we're talking about here is like sensitivity to time in a position relative to when we think the market's going to start to really make its move. And yeah.
So there's a lot there that we're really speculating on what could happen to Binance, how it would unwind, how quickly it would happen, what activity they would have to perform. Would they be selling directly into the market? Would there be a different action that would maybe delay how that happens? You have something like a sailor kind of moment where all of a sudden MicroStrategy goes out of business. I would imagine you're going to see some signs of some of the larger investors starting to leave that before that happens. But again, we don't actually know. So I think, Kodi, you pointed out that there's a reason to be cautiously bullish in this environment, given the amount of price action that hasn't happened below the 25K range. And then I think, JJ, you've painted a nice picture as well as you, Ben, about just the realistic path that we're going to be taking right now. Could be we stay in a range for a long time. So for all you listeners out there, you've been hearing us talk about this every single week. I suggest you come back next week to hear us continue to look at some of these news events that may be happening, as well as maybe some signals to start to direct us either going further north or further south. Obviously, we'll continue to do this as we head into Q4 as well as into 2024. With that, though, let's move on to the beta play. All right, guys. So this is the beta play. This is going to be our third installment of it. I'm excited because it's a great opportunity to be looking at specific projects and opportunities and really think long-term strategies, which is how do you position yourself for the next bull market, which we do believe will happen, although no one has a crystal ball and we don't know the time. But now is a good opportunity for you to take the time, do your research, and figure out where you want to position. So what we're doing is we're analyzing market opportunities and we're asking, will they outperform the benchmark in the coming cycle? And we do this by evaluating 3 category areas: network strength, monetary fundamentals, and technical analysis. Now, after we review the data, I'm going to go around the team. I'm going to ask them what they expect, whether they expect the play to outperform the benchmark. And this week, similar to last week where we looked at Ethereum and Cosmos, the benchmark is Ethereum, and we're asking if Avalanche will be a beta play. Now, Kodi's going to give us more of a technical breakdown, but I want to just read something that's directly from the Avalanche website, and it is this: build anything you want, any way you want on the lightning-fast, scalable blockchain that won't let you down. Choosing the wrong blockchain can kill your distributed app before it ever has a chance to succeed. But it doesn't have to be this way. Launch with confidence on Avalanche. That's some interesting copywriting. And the token for the network, or the primary token, is AVAX. And that's really what we're going to be asking about. Is it going to be a beta play to Ethereum? Does this network outperform Ethereum? So, Kodi, I want to turn it over to you to talk about network strength. Take it away.
Yeah, okay, so we're going to begin with the tech, just broad strokes. Avalanche is another L1 blockchain. The different one, or like the main differentiator, is that it allows you to create different subnets or different
We got
blockchains.
we got some noise in the background for the dogs that are coming out for you. They're excited about AVAX as well. Okay, sorry,
It
go on.
seemed to be.
Just to the audience, when we say L1, because we talked about Cosmos last week, and there was this idea that it's more of an L0. How do you define L1 for the audience?
So L1 would be just your run-of-the-mill chain in which you can have smart contracts. And L0, like Cosmos or Polkadot, are chains that don't necessarily have smart contracts on them. They become like a liquidity hub or like a cooperation hub for all the chains. AVAX actually is also a bit of a weird case. The AVAX network consists of 3 different chains, and one of them is another your run-of-the-mill L1. It's called the contract chain or the C chain, and it's an EVM clone. That means it's running the Ethereum virtual machine. You can use Solidity. You can run smart contracts on them. Transaction costs function the same way as on Ethereum. It's literally just another Ethereum clone. But it also has 2 other networks. The P-chain or platform chain, that's where the validators sit, and the exchange chain or X-chain, that's where consensus sits and from where you create assets. And this ability to create different networks or subnets extends beyond these 3 primary ones. Anyone can create a subnet on Avalanche, and that's like their main selling point, is that you can create your own sovereign blockchain with its own tokenomics, its specific requirements. You can build compliance within it, and it's really what sets them apart, I think. And up to date, we have 69 subnets, I believe. 52 of them are like full chains, and there are 7 main ones that I think are promoted by Avalanche. They are also really good at BD, business development, so they really try and get companies and teams to build on them. And yeah, long story short, that's Avalanche, the tech behind it.
So the subnet architecture, is each subnet a separate blockchain that is then validated through the one consensus blockchain?
No, they are validated by themselves. So each has its own set of validators. Most of them are more performant because they don't have as many validators. So yeah, like one of the promises of Avalanche is its high throughput, and it was sold as having 4,500 TPS, but that's purely theoretical. If you look at the actual numbers for the seed chain, it's basically the same TPS or even less than Ethereum. It's like between 2 and 7 right now, but that's mainly because of how low usage it's been seeing. During the bull market, it's up to 12 or 14 TPS, which is similar to Ethereum. So it's not great. And the main reason the transaction costs were lower there was because there was less usage and the token AVAX itself costs less. So what you paid for your transaction costs less. But with the subnets, you don't necessarily have as many validators. You can change the settings a bit and you can get higher transaction throughput up to 42 TPS, I think we've seen on average through these subnets.
So it sounds as though the theoretical goal would be to outperform Ethereum on a TPS level, on a TPS metric, transactions per second. And perhaps they can, but we actually haven't seen it in action.
Yeah, I think that's everyone's goal, but I don't think that's what Avalanche is zeroing in on. I think that their main selling point and what they're trying to get people to be excited about is the fact that you can create your subnets that use Avalanche tech, but it's its own chain or blockchain. And you can say it's a good idea because Polygon has launched subnets as well. They call it somewhere else, but it's basically the same. And we all know that Polygon only copies good ideas. But yeah, that's when it comes to tech. Regarding the activity on the chain itself, I'm going to talk about the C chain. That's where most of the activity is. And yeah, just as a reminder, that's the contract chain or the EVM clone. And it has a TVL right now of $550 million, which places it at number 7. It's 1.3 billion if you include staking. And stable sits at 1.2 billion, again, number 7. Most of it, 55% of it USDT. It has 330 listed protocols on DeFi Llama, and it has around 30,000 users daily over the past 30 days, which is not a great number. It's, if you Solana, for instance, surveys are around 80,000, same as Optimism. Arbitrum is 130,000. So just not that much activity. It did see a lot of activity at the tail end of the bull market. But it seems like ever since then, people are just not using it as much. But yeah, that could change anytime.
I wanted to ask you a perspective there. We're comparing this against Ethereum, and a lot of the literature and the promotion talks about how Avalanche wants to be the best tech, the easiest to develop on, the easiest to onboard clients. You just pointed out that their daily usage is actually fairly low. What's your perspective on whether or not they can increase that versus Ethereum?
I don't think they can. I think what they can do is have some like really successful subnets. I think that's what they should focus on. I think if they try to for their contract chain to rival Ethereum, it's not really gonna work. It's just a clone. Like the only reason you had some activity, it was because of lower cost and also because they incentivized usage. But at the end of the day, it functions in the same way. There's no new tech behind it in that aspect. Yeah, like I think the subnets and the consensus mechanism is also different and like an improvement on previous consensus mechanism is what allows them to run these different subnets and different chains. And that's what they should focus on. Yeah, that's my take on it.
A few different subnets and really promoting those. That makes sense.
Mm-hmm.
Is there anything else you want to share from a tech or diversity perspective?
Not that I can think of. I think that's mostly for.
Okay, so what I'm going to summarize is right now there's really no reason that you can see based on the technology that it would outperform Ethereum at a pure tech level and be able to attract more TVL and more users.
No, and there's not as much development on Ethereum or on other chains. Yeah, I just don't see it happening anytime soon.
All right. Ben, let's transition to you and talk a little bit more about monetary policy, where you're going to pack the token and how it's being used on the network and really see if it has an edge over Ethereum. Take it away.
You got it. So let's start off on this one, make it a little bit more simple and give the listeners a bit of a takeaway. In terms of a figure, if I were to rate the monetary aspect of Avalanche from 1 to 10, I'd give it about a 3.5. To help with that perspective, I gave Cosmos a 5.5, and Ethereum, which to me has the best policy at the moment, I have that sitting at an 8, and nobody is at the moment sitting above that.
Okay. So Ethereum is sitting at an 8, which gives it some room to grow and improve, which is great because there's a lot that has to be done. A 3.5 is pretty low, and I know that AVAX gets used at least for staking, and so it does have some utility. But walk us through how you came to a 3.5, especially below a Cosmos, which came out at a 5.5.
Yeah, so the way that I looked at this, I looked at supply, the usage of the tokens, its credit markets, and also the current economic output of the network. And then that's how I formulate this. But to get rolling on it in terms of the usage side of things, its primary usage in terms of why the token exists is payment for transaction fees. And for a layer 1, that's good to see. It's essentially the lowest form of usage. And anybody that wants to talk about governance tokens and how important those are, I personally don't buy that one in terms of how it's going to relate to price. Maybe Curve, we can talk about that, but that's really to the extent of usage and governance. But primary usage, Avalanche, paying for transaction fees. So in terms of how much we're talking about here, we're seeing about 1,000 tokens per day. Right now, account for that usage. And these tokens are burned. And if we were to annualize that figure, we're about 360 to almost 400,000 per year. It's down on the year, which is important to consider because the overall market is down. But to give a little bit of framing of how much is 1,000 tokens per day, we should look at the supply growth of the token, which over the last year was 58 million tokens. And so the current burn rate is barely making a dent in terms of the new supply that's hitting the market. To become deflationary, we really need to see over 100,000 per day AVAX getting burned, and the best days that it had, we saw it topping out at just over 10,000. So it's fallen short, which tells me we got a bit of a supply overhang taking place on the Avalanche ecosystem. As far as how that supply is actually being used, so this is a higher order usage category, which is staking, and according to Staking Rewards, I got that figure at 54%. I'd like to see this number below that 50% threshold. As to why we don't, we can go ahead and see where the other tokens are locked up in the ecosystem. The llamas go ahead and report they say 54 million of the 354 million tokens are accounted for in TVL, but it's important to note, and hat tip to Kodi here, is that this is not reported in native tokens. It's just the total value locked and then displayed in terms of native AVAX tokens, but it's not native AVAX tokens in terms of the amount. So optimistically speaking, if this were all AVAX tokens, it would be about 15% of the supply. So realistically, the amount that's used throughout the ecosystem outside of staking is probably more like 7 to 8% right now. And most of this sits in the Aave lending market. And outside of Aave, we do see it used in various financial protocols. The top 10 in terms of TVL sitting all over 10 million, which is healthy to see. But the TVL is a bit top heavy. So if we go ahead and dive into that top heavy stat of Aave, I actually start to get a little bit worried.
Yeah, I was going to say this doesn't sound very well distributed. So I'm very interested to hear your perspective on your worries here, what you think is the problem and perhaps the way in which it could resolve itself and actually improve the token policy.
Yeah, we got to think of it like incentives. If we go ahead and dive into Aave, is there a reason why people would go ahead and maybe let go of their AVAX and drop it into the market? And we can always kind of assess that based upon what is the return that somebody is making in all these other use cases. And if you dive into Aave, they're currently, for anybody that's lending AVAX tokens on the protocol, it's yielding less than 1%. Compared to staking, we can see that this feels a little bit illogical. Is somebody getting compensated to provide that liquidity? Or is this sort of collateral damage that took place from the market bottoming out last year? I'm not sure, but seeing Aave sitting with such a lion's share of TVL in terms of Avalanche, assuming that all those tokens are Avalanche, and looking at how the credit markets sit, that has me even further worried about this supply overhang issue.
This sounds like a fairly ugly picture at this point. Help me out thinking about where they could go to actually improve that picture. And if I think about Ethereum's economic output and what they're actually doing in terms of how the token's being used, do you see a path for AVAX here?
Not optimistic, unfortunately. If you want to try to reduce that supply overhang, you really need to ramp up the amount of fees that your network is capturing. You got to really change the user's behavior of how they're holding the token. And hopefully that spurs better rates in the market on lending protocols or the yield that individuals will be earning on DEXs in order to get that token distributed out, have greater diversity of the use of that token. But to get there, you really got to have essentially a lot of builders making really the way that we can measure this value is smart contracts. How many smart contracts are really getting put out in the market? Is there a base that's being built that Avalanche can go ahead and if there is some sort of price incline, is it going to be sustainable? If we go ahead and pull up the daily verified contracts chart, this is for the C chain to be specific. And I know Kodi talked about the differences between these things earlier, so that's just an important caveat. Right now, we're sitting in the teens, and this is the lowest it's been. In its heyday, it was producing anywhere between 100 and over 250 contracts a day. And now we're seeing such a low value, which this has been unfolding for the last, it looks like, year, which is a bit concerning in terms of any price rise. It doesn't really have a lot to build off of here going forward. So to sum it up, the monetary situation, there is this supply overhang. The credit markets have a little bit of non-logical behavior taking place, like with Cosmos. And we talked about that last week. There was an opportunity to move tokens out of staking into these other protocols and act as a bit of a catalyst, but this doesn't really exist for Avalanche. So hopefully the building can help support a lot of these kind of negative components that I'm drawing attention to, but we don't see that either. So big concern here with what's going on with Avalanche.
I just wanted to add that one of the benefits of the chain was low transaction fee, high throughput. And as you just mentioned, if you want to increase fees, that could perhaps help out with the token, but that would go against what they're trying to achieve with the chain. Or am I thinking about that incorrectly?
No, I think you are. It's hard for, I would think, these engineers to want to raise the price of consensus or the storage of state or compute, because that kind of goes against everything that they're building, and they're trying to build very efficient consensus protocols. And so if you actually want to go ahead and raise price, that's going against what you've set out to do. But when it comes to supply and demand, the market needs it. If you look at water, I think is probably the best example here. It falls from the sky. A lot of people think this is a resource that is very plentiful. And do you sometimes keep the tap running? Yes. Do you sometimes run the sprinkler when it's raining? Yes. It's because of the cost to go ahead and have fresh water for many parts of the world is relatively low. And because of that, you have this incentives and you have this behavior that starts to take place around it. And when it comes to blockchains, if the price creates an equilibrium, that allows demand to shift, everybody's kind of activity shift in place as well, and that responds to the token's price, you're going to have a better marketplace unfold. And we don't have that right here, right now.
Okay. So just to summarize where we are right now, we've gone through the technicals and we haven't seen anything that would really outperform from an Ethereum perspective. Ben just laid out the view on AVAX and again gave it a 3.5 versus Ethereum 8.5. So again, underperforming the benchmark. Let's see if the technicals give a different view. So JJ, I'm going to hand it over to you. Tell us, what are you seeing from a technical perspective for Avalanche?
I think Ben might have been too bullish, to be honest with you.
Jeez, okay.
Let's just simply put, do not attempt resuscitation because it looks dead. It looks like a 2017 era ICO coin, the way those looked in 2018. Everything that Ben just laid out in terms of the broken tokenomics, you just see that reflected in these charts, is that anytime price gets a little bit of a bump, there's just way more supply than there is demand. You could probably chalk that up to the various scams that were going around in 2021, that flywheel effect of venture capitalists creating these tokens that would just make them the most insane amount of money in the shortest amount of time without thinking through any of those long-term issues that kind of Ben laid out there, just the broken incentives, and it doesn't work. The chart is a reflection of that. It just goes down. It looks like there's no buying interest in this whatsoever. I wouldn't expect it to outperform other than in just a very brief window. It might act as exit liquidity if perhaps we get another bull market. There might be the hot potato game of the week at some point, but that's its best case scenario looking at it now, unless something drastic changes.
Yeah, the charts are pretty ugly, and I think they speak for themselves. And given everything we just heard on the technical side as well as the monetary policy, there's really no reason to expect this to really outperform Ethereum. Is there anything that you would add to what I just shared?
No, it's dead.
Okay. All right. I think this is a pretty quick wrap up on the Avalanche technicals from that perspective. I do want to go around just to keep some consistency here from the team. The question is, do you expect Avalanche to outperform Ethereum as the benchmark in the coming cycle? Kodi, I'm going to ask you first.
Not on a risk-adjusted basis, and probably not even at any point on a non-risk-adjusted basis. I don't know. Looks dire.
Yeah. I wouldn't expect you to say anything any other way. Ben, I'm going to ask you the same.
No. When it comes to Avalanche, its primary use case was lower fees. When congestion hit Ethereum, we saw a lot of individuals start to move over to Avalanche. I think it was in August of, I want to say 2021. That gas fee started to spike. People went ahead into Avalanche, and they went ahead and made a lot of money. But now when we look forward into the future cycle, are they going to be able to win some sort of narrative to attract individuals, especially with lower gas fees as Ethereum fees start to spike? They're going to have to battle with L2s, and I don't see that happening based upon the activity taking place today.
Okay, a good, rational, logical explanation of why it's not going to outperform. JJ, I'll give you the final word here.
Less than a 1% chance of it outperforming.
Okay, less than 1% chance. All right, well, that's going to wrap it up from a beta play. The conclusion here is Avalanche will not be a beta play to Ethereum on a risk-adjusted basis or otherwise. So if you're hearing someone spin this token to you, try and pump it up and tell you all the things it can do, I suggest re-listening to what these gentlemen just shared. And unless there's new information, this doesn't look like it's going to outperform. And you should adjust your expectations and portfolio accordingly. All right, so from that, we're going to move on to the like it or spike it, where Kodi gets to look at 3 new projects and tell us whether he likes it or spikes it. Kodi, you ready? Oh, you may be on mute, buddy.
I was on mute, yeah. I am ready now.
Okay. All right, you got some good ones here today. All right, the first one, Maker ETH and Maker USDT at 1-year highs. Like it or spike it.
Like it.
How can you not like that? All right, unpack it for us. What does this actually mean?
Yeah, so I think most people, me included, had left all DeFi for that, and it's coming back with a vengeance, particularly Maker. And it's mainly about the fact that they are incorporating RWA, so like real world assets, on their business. And yeah, yields being higher for longer than anyone expected, and they're probably gonna keep being higher for a while. It's just great for their business, and that is being reflected on price. It has not been this high since late last October 2022, and that was just the market was doing wacky stuff back then. Everything was crashing and whatnot. But yeah, both in USDT terms and in ETH terms, even it looks like the chart is coming back, and that is mainly because Maker as a business is just printing money. If you look at the profit right now, annualized, it puts it at 60 million and has a P of 20. And it's just been going up and up. Income is at 180 million. Started the year with only 40 million in income and 20 million in profit. And yeah, the TVL and the number of DAI that is on the market is also increasing again. And yeah, it's been increasing for the first time since basically Luna happened. DAI supply peaked at like almost 11 million at the top of the market. It crashed until between 5 and 6 after Luna happened, and it's bled out from there. And it's been increasing lately for the past month or so, ever since they started this DSR, that's the DAI savings rate. Basically, they are offering the 5% that bonds give to anyone that wants to park their DAI in there. And since not all people do, they can allow themselves to push the yield that they can give and get more DAI created. And yeah, DAI has increased from, I believe, 4.5 bill a month ago when they started to 5.5 now. Yeah, correct. So yeah, like
I want to jump in here because
Yeah.
this is an interesting. It could be it's a counter signal. It's a bullish signal compared to what we were talking about at the beginning of the podcast. Tell me, the real world assets is a very large bucket, you will, of different ways in which you could tokenize different things in the world and then put them on chain. When you say that this is gaining some traction, you mentioned the savings rate as well as real world assets. Do you have a perspective of there's anything specific that's driving that activity?
Yeah, so for Maker, what they are doing is they are using real world assets, mainly bonds, as collateral. The way that Maker and DAI works is you give them ETH or some other token as collateral, and then you can mint DAI. And they've been shifting that towards bonds. So like right now, out of the almost, a little bit over 8 billion in TBL, 3.4 of that sits in real world assets. That's mainly bonds in American banks. That poses some potential issues if they have run-ins with the law, so to speak. But right now, it's working great for them. Like they are, it allows them to make a lot of money because, as I said, they don't really pay the yield for all of that to all tokens. They should all token like DAI token holders. So yeah, it's great business for them. So it is, as long as bond yields stay high, then Maker will just keep on making new highs probably and be a good token to be in.
Okay, so some risks there that you shouldn't ignore or sleep on, but good news all around on that one. Okay, let's move on to the next one. Botnex, I don't know how to pronounce that, announces a layer 2 for Bitcoin that runs the EVM. Like it or spike it?
Like it.
All right, I hear Bitcoin and EVM in the same sentence. My brain just explodes. I'm confused. Unpack this for us.
Yeah, we don't have much data for it. They are still on waiting to launch. But long story short, it's Bitcoin rollup that would settle on Bitcoin, but it is running the EVM. So you would be able to have smart contracts on it and perform any of the things that you can do on Ethereum. But the token that you use to transact would be Bitcoin. The funds would come from Bitcoin through this Jinx system. They called it the spider chain. So you would bridge your BTC and they would issue some like IOU, let's say. The original BTC would be in different, they call them orchestrators. I think it's just pool of stake tokens that would secure this Botnex chain. And yeah, again, we can't really say much. It hasn't been launched yet. And I'm definitely not technical enough to say how good a solution this is. I'm just excited about people doing things on Bitcoin. We've seen the emergence of ordinals, and now we're seeing people like some devs trying to spin rollups on top of Bitcoin. That I really like that. That's just my take on it.
That is exciting.
So yeah.
So answer a question. Maybe this is above your technical understanding, but could you have a maker solution where the Bitcoin is being used, deposited, and then being used as collateral to buy into bonds, like we just talked about for Maker ETH?
I think it's just apples and oranges. Like in this case, the Bitcoin would be used to secure the second bottom exchange. So like you would bridge your BTC out of the BTC mainnet, and the BTC would sit in these staking pools to secure the new network, and you would use some kind of IOU on the new network itself. You couldn't really use that to buy something else outside of the chain, if I'm not mistaken.
Okay.
So yeah.
Not quite the same as having EVM directly with Ethereum, but definitely some opportunities that we would have to see if they actually grow as the chain is launched, as the solution's launched.
Mm-hmm.
Okay. All right, we got one last one here, and this one a little bit of a doozy. Eclipse announces a L2 rollup that runs a Solana virtual machine, settles to Ethereum, and uses Celestia for data availability. Like it or spike it?
Like it.
Okay, this almost sounds too harebrained for anybody. I got all these different chains. Walk us through what's happening here and why you like it.
Yeah. So Eclipse is taking the best of all worlds approach. So they are settling to Ethereum. That's because Ethereum is the most secure chain. It settles most of the value in crypto. And then they are using the SVM or Solana virtual machine for execution. So basically, the Eclipse rollup will be running on a Solana clone. And that's because, as we've discussed in the past, the EVM is really not as performant as some other virtual machines. One of the main drawbacks of it is that it doesn't allow parallel execution, among other things, like lower TPS and higher transaction costs. So the guys at Eclipse are like, okay, how about we just slap a more performant virtual machine and then we just settle to Ethereum as a rollup? And yeah, that's what they seem to be doing. And the last one, they're using Celestia for data availability. Just is about like for being able to source the data for a chain on demand. So you as a user of a chain, you would like to be able to download the data that a chain has on like its past history and to be able to validate that what the chain is, like the chain state, you would like to validate that based on past data. So Celestia allows you to download the history of a chain in a sense, and it doesn't have to see it on the chain itself. So it's another building block, let's say, that doesn't run on the same chain as the execution model, with that would be the Solana virtual machine. So it doesn't take away any of the high throughput that the SVM would have. So yeah, what they're doing is like separating one chain into different modules. So that would be the execution layer on Solana, data availability on Celestia, and settlement layer on Ethereum. And yeah, I think it's quite exciting. I can't wait for them to launch.
Very excited. Do you know when they're supposed to launch? Do they have an ETA?
I do not know. I think it's not coming soon. Like they just announced Celestia also. It's quite recent. I think they just dropped the token like literally hours ago, and it's not really widely used yet. So yeah, I think it's still a few months to come at least.
We're going to have to bring this one back and see how it evolves and what kind of traction it gets. Definitely exciting. All right, Kodi, enjoyed all three of those. Now, let's move on to our radar, and we're going to do this one a little bit differently. Most weeks, we cast the team to spend a lot of time doing the research, bring up something. Today, we're going to make it a little bit more of a jam session. And JJ, I'm going to hand it over to you because you have a data point that you wanted to share, and we're just going to go around the horn and see what people have to say. So take it away.
Yeah, so something I've been looking at is TLT, which is the iShares 20-plus year Treasury bond ETF. So it's the second largest ETF that exists. There's currently $16 billion under management, and it's just been sinking like a rock since the Fed started hiking rates. And it seems like there's no bottom in sight. However, according to Eric Balkanis of Bloomberg, people keep piling into it. There's been another $750 million allocated this week alone, and yet price is barely, it's actually still down on today and down on the week. So it's just interesting to see. I'm not an expert on this sort of thing, but to see bonds falling the way they are, this has a pretty high correlation with Bitcoin. Something to keep an eye on. It would rise in the event. It seems like when the Fed cuts rates, this would rise, or if there was a market crash, this would rise. It's seen as a safe haven. We saw it spike up to about 180 during the COVID panic. For reference, it's around 89 right now, so pretty sharp fall off the lows there, and just interesting, something to keep an eye on from a macro perspective for sure.
Yeah, I'm looking at the chart here. It looks like it hasn't been this low, if I'm not mistaken, since 2011.
Yeah, it's encroaching on all-time lows. It looks like around the 70s or so in 2000, the early 2000s.
Yeah.
So 2004, it was at $80. Look, maybe the low 79. Yeah, so actually, it's looking as bad as the AVAX chart.
No, let's not be that cruel. Ben, I want to ask you, you just heard Jay mention the idea that maybe this is used as maybe, correct me if I'm wrong, Jay, you were saying that they're buying into this in case we see a downturn. This could act as a safe haven. This could act as some insurance. Is that kind of the view?
So I see the logic there would be markets crash. Say the Fed keeps hiking rates, liquidity leaves, markets end up crashing. The Fed's response to that's telegraphed, right? We all know what they're going to do is they would cut rates. And in that event, bonds would become an attractive safe haven, I believe is the thinking there.
Ben,
yes,
what's your perspective? Yeah.
I think we just need to remember what TLT is. It's essentially an ETF that's full of a bunch of U.S. Treasuries with an average duration just over 20 years. And as yields start to rise, the bond price starts to drop. Like if you were to view it as like $100, let's say, and you want to make 5% on that bond, and you originally bought it with zero yield, then you probably need to sell it around $95 and change in order for that yield to exist in the market at kind of current rates. So the fact that the price is similar to what it was in 2011, like if you pull up a 30-year yield chart, that makes intuitively a lot of sense because that was the last time rates were where they're at today. As far as, because I do see some of this chatter too, everyone's, oh my God, TLT is dropping like a rock. When's the bottom? Why is this doing what it's doing? I think a lot of this is just simply, this is what's happening in the yield market. The U.S. Treasury went ahead just a couple weeks ago and they just said that, look, we're going to go ahead and start issuing more bonds on mid to long dated terms. So this would be the 10-year, the 20-year, the 30-year. And as they go ahead and do that, there's going to be more supply in the market, which this allows yields to start to rise. And this is going to normalize the curve. And so TLT on this expectation should theoretically just keep going down until we get to a point where this yield curve starts to be normalized. And right now, it's, 4.67% on a 30-year, 4.54 on a 10-year. So you're sitting right around 4.6% between that. And on the short end, you got rates sitting around 5.5%. So we have some serious movement still taking place here if the Fed's going to be successful to normalize this curve. And I know this if that I mentioned is bold, underlined, italicized, and all these different things, which I think is what JJ's really hitting on, which is if the Fed has to change its current course, this thing's just going to be a slingshot. And if anything, it's like a great insurance policy in terms of a call option.
What's interesting, though, is that we haven't seen, as low as it is, there's been no capitulation. So like I said, second biggest ETF still. $16 billion, I guess it's what happens first. Does the Fed change course? Do those people puke their positions much lower? We're just waiting to see what happens.
I'm not entirely sure. A lot of the pricing is just holding treasuries, so it's just the price of those bonds. As soon as they start to release a lot more supply in the market, that's going to affect prices, which will in turn affect TLT. So as far as is there going to be like a squeeze of some sort that unfolds on TLT, to maybe some extent, that's probably true. But I think a lot of it really just tracks what's taking place here on the long end of the curve. And I based on a lot of the comments, we wrote about this back in January of this year that, hey, look, Powell's main concern this year is to try to normalize the curve. This is how he's going to try to go ahead and do it. Like you can't allow these 1 month, 2 month, 6 month yields to drop below the federal funds rate because that just creates this inefficiency in credit markets that is not helpful for what the Fed's goals are. I think most recently, like you have all the way up to the 1 year. It's pretty efficient. It's all trading around 5.5% yield. And so now you look at the 2 year, they had an increase in the supply over the last month and the yields are starting to make a move. So they're just trying to normalize the 2 year. And then we'll just keep going down the 5, the 7, the 10, the 20, the 30. And these supplies are going to help normalize it. And over time, this should create some efficiency back in the marketplace. It's just, can the Fed actually do it based upon how much liquidity it has in the reverse repo market?
So Ben, I want to ask about that. What do you think the path is that they take if we start to see cracks in other markets, commercial paper as an example, or real estate? Do you think that they stay the course to normalize the curve, or do you think that they're going to have to take a plan B to make sure that crash or that stress in the system doesn't expand?
I do expect to see two things. I expect to see a change in collateral requirements at the bank. And this, on the headline effect, is going to be perceived as draining liquidity in the marketplace because now banks need to go ahead and hold more capital on reserve. But the question is, what is that capital? And I think that program, the Buy TFP from earlier, let's see, that was like in March on the heels of the Silicon Valley Bank insolvency issue. They're basically already treating treasuries at par value. And so if that's essentially premium collateral, I would expect them to change the definition of what can be part of that collateral requirement. And so what does that do? It actually frees up a lot of liquidity. So I think they're actually, if we see a major move in the market, and a lot of it has to do with liquidity issues, I think addressing that concern in this manner is going to be how the Fed responds. And it's going to be that catalyst, I think, that just kicks the market off towards a melt up.
I was going to say, so if they change what they're considering as collateral, that would allow the private sector, the banks, to have more liquidity to lend out to the market. Is that an accurate assessment of what you just said?
Yes, one of the issues was having like dry powder to go ahead and act in the treasury market. And because treasuries, once you drop them on your balance sheet, it's essentially a risk, and you have to back that risk up with additional collateral. But what if that asset is your collateral? It changes things on your balance sheet.
Right. Okay. Interesting. So I think the perspective I have listening to you guys talk is that this may be an interesting call option for people that are expecting the Fed to have to change and to pivot. Although I think we're all, perhaps the market's been a little surprised at how long the Fed has gone without having to pivot. Ben, you've talked about many times on this show how it's possible that we'll actually achieve the softer landing, not without turbulence, but a softer landing. More to watch here. Suggest all of you listeners come back every week to hear what we're saying as we track data like this and others. All right, so we're going to move on to the last question of the show, which I started asking at the very beginning, which is, where are you investing outside the crypto for the coming 10 years? We started off the show with an assessment of crypto, and it's a little bearish. Kodi was able to add a little bit of a bullish view. Then we talked about a couple of signals. Kodi just shared one where it's possible things like Maker, DAO are starting to see some life in them. But that doesn't mean that we shouldn't be looking outside the markets, or that you may not be looking outside of other markets. So I want to ask you guys, how do you think about that investment? Where else would you look for investments for the next 10 years? Kodi, I'm going to start with you.
If I could go back in time, I would just buy mortgages or like houses and mortgages when they were at 0 or 1% on log trades. Since I cannot do that, I think the next would be commodities. If you look at the performance of commodities in inflationary times in which the Fed funds rate is higher, it's as best as you can get. Bonds perform terribly, stocks perform okay-ish. Commodities have their time to shine. And yeah, I guess it would be ETFs that track those, like a basket of commodities.
Baskets, coal, nickel, uranium.
Oil,
That's
yeah,
what,
all of it.
oil.
Uranium, yeah.
Okay. All right. Commodities. I think that's a popular bet. JJ, what about you?
I actually joked on Twitter earlier that if DXY keeps moving up, the best thing to invest in is leverage volatility ETFs because the market's just going to tank pretty soon here. But long term, I think that's the way I think about these things, is that if, say, we get that blow off top in the dollar and volatility comes and markets blow up like they did in March 2020, we ultimately know what the response is to that. And that's just more and higher inflation. And the next bout of inflation, historically, you look at these things, they happen in waves. And I think we went through the first wave of inflation. The next one's going to be even bigger. And at that point in time, I don't think you want to be stuck holding dollars or anything related to the U.S. debt, as it's going to keep ballooning. So I think Kodi's thesis, commodities, energy, anything that's hard. Hopefully Bitcoin fits into that basket, gold, all these things that would give you some protection from the doomsday scenario of dollar inflating and the debt just continuing to get more and more out of hand, as it doesn't really seem like there's a good solution to it. We just are running on borrowed time and it's working, but at some point, I think we run out of solutions to the debt problem.
Yeah, there is an into the runway. We just can't see it from here. Ben, so we've got two people going for commodities. Weigh in here. What are you looking at?
Mine's going to be left field here. So
Okay.
I'm going to borrow from the Bretton Woods 3 thesis, which was really about diversifying in terms of a nation state, basically investing in your supply chains, investing in, what you're trying to export out to the rest of the world. So with that sort of in mind, I'm investing in businesses. I want to build various businesses within the ecosystem. And because, or I should say, if this proves to be fruitful and successful, it's my inflation hedge, because as inflation starts to hit the economy, then if revenue starts to, and those margins stay put, then that would be a hedge against inflation itself. I know that's not realistic for everybody. And if this were to be a little bit more of a kind of takeaway, if you will, it's just invest in yourself. What is it that you're really good at? What could you really build on to really maximize your skill set moving forward in such kind of a hopefully not too volatile environment, but it does seem to be alluding to what JJ said, like volatility is going to be extreme. So what's the thing that you can count on the most? It's going to be really what you spend your effort doing.
Okay, we got two commodities and an entrepreneur. And
Can I give a shout out to my friend Don DeBell here from Twitter? So
Yeah.
he said uranium and their ETFs do look bullish. People have been saying it for a long time, but they're finally actually showing signs of breaking out. And I think that's part of that energy play we're talking about. And that's a specific one that you could hop on if that thesis makes sense to you. So thank you, Don.
Thank you, Don. All right, and all you listeners out there, what are you looking at outside of crypto? Are you looking at commodities? Are you looking at businesses? Perhaps you're looking at AI because you think that's going to be a captured play. Let us know in the comments what you're looking at. We'd love to hear. And with that, we're going to wrap up this week's show. I want to thank JJ, Ben, Lilly, and Kodi for dropping by. This was a very interesting show. We had a lot more discussion on the market and a very good perspective on what's happening there. If you don't want to wait until next week to hear what these guys have to say, I suggest you follow them on Twitter. JJ's mentioned what he's doing, interacting with folks and getting their perspective on plays. So you always get to hear their alpha out there. And the last point, which I'll make, which I do every week, is that we are getting that much closer to having our charts and graphs and video up and running. In fact, one of our producers is with us today. He's listening in. The hope is that we're able to get the hardware up and running to him, and we're able to start doing some video, testing that out, and I would say unleashing it out into the wild. So with that, I think we should take away from this episode, we're in unprecedented times. It's not boring, but that doesn't necessarily mean that it's low stress, low anxiety. So be cautious and calm when you're making your investments. Think long-term. Take what these guys said and put that into context for your portfolio, and always keep some dry powder. That's got to be the only advice I have to go with every single time. But with that, I'm going to wrap up. This is Marconi White signing off.